Okay, very good morning and welcome to the briefing then for Tuesday 28th of February. Just having a quick recap then of the overnight news and what we're looking out for today. And one of the most surprising things that I read this morning was talking about the fact that federal funds futures, what we track in regards to the expectation to define whether or not the market's price for an interest rate hike in the US from the Fed in March or June and so on. Actually, that saw quite a sharp move really yesterday afternoon our time. So after we'd gone home, we are now priced in for a March hike for the first time. Obviously, we were talking about this before, about how really the consensus, we were looking at the primary dealers yesterday where 22 of the 23 were looking for June, not March. I still kind of agree with that at this point. But certainly looking at the charts here, there was a little bit of movement yesterday evening that seems to be, there was not one fundamental kind of headline catalyst for it. But you can pretty much see that if we look at 5 o'clock London time, some of the movement across markets definitely kind of validates that repricing of the market. So this was treasuries over about an hour period between 5 and 6. We moved lower by about, well, really was about 10 ticks on not a great deal. Elsewhere as well, in terms of the currency markets, looking at the euro, really that was 5 o'clock. So you can see the dollar's strength just weighing on the pair. Same thing happened as well in regards to cable, but to a slightly lesser degree. And then if you look at gold as well, gold came off as well quite aggressively. So definitely yesterday afternoon, or evening I should say, this was after the European close, definitely without really much rhyme or reason, the market decided to quite aggressively reprice its positioning and the odds of a March rate move. And certainly these asset movements would reflect that. Yields moving higher, the dollar appreciating, and gold coming off a fair amount as well. Keeping in mind though, gold's had a very good run on the upside, and so that may be a little bit understandable with a bit of profit taking. But if I show you the chart of what I'm talking about, it really goes to show in a bit more detail. You can look at this from blue and white, so overnight index swaps, and also from futures markets, what we're pricing. You know, we've hit that magic kind of number of 50%, which means that it is now priced in. Whether or not that will remain the case and priced in, we will probably know by this time tomorrow morning, because probably, as you just saw, Senor Trump would have spoken by then, and we'll have a much better idea of how the landscape will lie and the timelines for the Trump administration to push forward a lot of the plans that the market has been very much, from an equity point of view, stimulated by. So calendar-wise as well today, it's going to be a lot more busy in the afternoon. However, one word of caution that I would say is that potentially, even though we've got quite a lot of big data coming out, let me just show you what we have in the afternoon, because really there's not a great deal coming out this morning from UK or Europe. You've got core PCE, so obviously the Fed watching the inflation situation very carefully. You've got trade balance, wholesale inventories, real consumer spending. You've also got Chicago PMI, Richmond Fed manufacturing, consumer, or the Conference Board's consumer confidence figure. So there's a lot coming out of the US today, but what possibly could happen is that despite this, the market might be a bit disinterested in reacting too harshly to these economic data points, given the fact that the bigger event is ultimately going to be Donald Trump. And I've just looked to verify the timings of that. That does not happen until 9 p.m. local time, that's Eastern. And so actually, it's not going to be around until 2 o'clock in the morning, our time, when his speech is actually delivered to both chambers of Congress. So what might happen is, you might get a bit of a tentative session where, think about it, if you were a big fund or an institutional player, you are very unlikely to be executing large-sized trades, you would imagine, ahead of such a big event which carries a high degree of risk and uncertainty, depending on whether he can deliver or underwhelm, whatever the case might be. So maybe to keep that in context when you're reviewing the kind of aggressiveness, I would say, of the trades today. It could be negated a little bit by the calm before the storm, so to speak, in that sense. Quick look back at the charts though, and how the land lies, if you like. The dollar this morning has been just moving up a little bit as Europe has come into the market. We're pretty flat there, but I can just see on the top left hand of my charts, the euro is just edging here a little lower more recently, away from pivot. Likewise, just sub-pivot in cable, and gold just touching session lows again here. With gold, I'd keep an eye on that low. We're not far from it, 1251.5 from where we were, where we sold off in the late US evening or afternoon yesterday. And obviously gold has been on a pretty phenomenal rally of late, so any further move to the downside could pick up a bit of momentum if some technical levels here get broken. So keep an eye on that. Equity is pretty subdued. The Nikkei was a bit of a underperformer overnight, down just shy of 1%. That coming after the yen, it weakened during our session yesterday, but it rallied all the way through the Asia Pacific session, and as such that weighed on the export names within the Nikkei index. Okay, let's have a quick look at some of the news items then from this morning. So aside from that repricing short term for a March hike expectation, France is obviously still very much at the front of the queue in terms of macro themes at present. And some of the headlines this morning have been talking about the French court probes have left Le Pen unscathed as Fillon bid falters. Pretty much you could say that at this given point in time, Fillon is really not in the running now. It's more Le Pen, Macron, especially with the pickup of other party backing that Macron's managed to secure over the last week or so. Le Pen, though, despite coming under similar pressures to Fillon in regards to both have had criminal probes, they both tried to fend that off, but it's definitely impacted Francois Fillon much more. He was always a guy who was saying he was a straight shooter. He kind of pinned his campaign quite heavily on that before, about his honesty and integrity, so it definitely has hurt him more with the voting public. But Le Pen continues to lead, certainly on the first round, and certainly looks set to be in the runoff. Who that's against at this point looks to be Macron. Putting this into some slightly different context that I was reading this morning, and what's quite interesting was, you can see here Fillon's lead over Le Pen has been falling in recent weeks, whereas Macron's lead over Le Pen has been falling, but has somewhat recovered more recently. You can see that's what I'm talking about with Beirut, that was last week. That centrist alliance really helped re-widen that spread. One of the things, though, that a lot of people often ask me is about Brexit and Trump polling errors. And this is a good thing that I just want to quickly touch upon, because this is what Deutsche were looking at in a report this morning. Because people often say, why should we believe polls? They've got it wrong on both occasions. The Brexit was probably the worst one. They were a little bit better for the US election, but still inaccurate. So what Deutsche Bank have essentially done here, well, let me just go back to the details. So to put this in a bit of context, in the US, polls underestimated Trump's support in the popular vote over Clinton by 1.9 percentage points. In the case of Brexit, in the week before the referendum, polls' average margin of error versus the final result was 6.2 percentage points. Now, that's a pretty massive amount when you think about, actually, it was only around a 2 percentage point win for the Leave in the end, but they were substantially away from target in their accuracy with the polls. What Deutsche have done then is they've looked at applying the last week's Brexit margin of error to the current French polls. So what you can see here is the thick or definitive green line going through the middle is the Brexit situation. You can see here ended up being minus, indicative then of the eventual result to Leave. But that's where the polls were sitting, was positive on the upside that we would remain. That obviously didn't remain the case. The difference of polling error to actual result, 6.2 percentage point. Basically, they've applied the same margin of error from the Brexit to where we would be if it were Le Pen, Fillon, and Macron-Le Pen. The one I'm more interested in at this point of time, because the way it's looking, is that it will be a Macron-Le Pen runoff. So I'm looking at this yellow line, which is currently, as you can see here, on the left axis, there's a 20 percentage point leaning in favour of Macron at this present point. So that's where this price point is, where this last print on the solid yellow line is. Then if you apply the same margin of error of Brexit, which let's not forget was very large, that only puts us at about what would be 14%. So when people talk about actually the probability of Le Pen winning, not only in the case of Brexit, you had to swing, a marginal single digit percentage, and that being low single digits in order to sway the vote. If Le Pen is to win, the polls don't only need to be wrong, they would need to be almost 15% off target, which that's a bit of a push, you would think. I mean, you're talking about, yes, I understand as well about the kind of the human psyche of not wanting to put out there quite a far right leaning view with the fear of being criticised in the public domain in terms of us as individuals. That could arguably be one of the reasons why the polls weren't so accurate in terms of, can you actually support a guy like Trump and not come under criticism of being, against immigration and all these types of issues. But this is a two-round system, and if you think about it, if you were anyway kind of centre or left, which let's face it is a large proportion of people out there, then you're not going to vote far right. And so actually when your party candidate falls away in the first round, then you go to a centrist member or a far right national party. That's then, with Brexit it was one and done. With the elections it's obviously one round. With France though, it kind of eradicates that possibility of that what if scenario actually materialising. So this is not to say that it might not happen. Le Pen might win. We've discussed that though. That would have also limited powers given the fact that she wouldn't have overall majority by a long shot in the National Assembly, which is the French Parliament. But what I'm saying is that looking at these polling and this analysis, it just kind of ratifies the market thinking, I think, that although nervousness might pick up as we get inevitably closer to the vote day, Le Pen's got a big task in order to turn around a huge double-digit kind of difference here. Don't forget, that's 20 percentage points she's behind Macron at the moment. If you're looking at applying the Trump-Clinton margin of error to French polls, then it's even smaller. We were looking at 1.9 percentage points. So the point being here that, again, the actual reality of a Le Pen win, I think, in actuality is much, much lower than what we've had in Brexit and Trump. But never say never. Of course, Trump then is the big topic of today. Let's have a quick look at that. Putting the final touches on his speech, focusing on the economy and defence. This is one of the big ones we've been waiting for. We've had all the tweets. We've had all the kind of drumming up of interest for this event. Asset prices have moved. Now it's about delivery from Donald. We had a record high close once again. I think it was the 12th consecutive day in terms of the Dow Jones Industrial Average. It's the best winning streak in the index for 30 years. What could possibly go wrong this evening? This is, I'll get onto that shortly. There's a very good article I want to discuss by a chap that's a very good market pundit that you should follow for his insights. But we'll get on to Mohammed El-Erian shortly. But let's just have a quick look at the setup for Trump's Congress speech. Now, don't forget, this isn't until 9 p.m. Eastern time, so this is going to be overnight, early hours of the morning, London. So realistically, from a trading point of view, you either can tackle this one of two ways, I would suggest. You either stay up all night, so go home, 4:30, get some sleep, wake up about midnight, and then trade through until, I guess when the speech is delivered and digested, probably about 4 in the morning. So you can trade those moves. It's one way. The other way is get in super early and then try to trade the move as UK and Europe come into market and they interpret the information that's been delivered from Trump and how Asia has also reacted in terms of movement in the market. Now, looking at Trump's speech, this is a really excellent infographic by the guys at ING. And what they're looking at here is the 4 areas of Trump's speech that investors will be focusing on. So tax policies, reforms, infrastructure, squaring the budget deficit, trade and protectionism. Now obviously we had a couple of comments from Trump yesterday, and so that's what the asterisk denotes here, is what the president hinted at on Monday. So keeps it high level and only reiterates tax simplification pledge, big infrastructure spending, but no size and timing of details. Again, that was what we were looking at yesterday. This word big, no details though were forthcoming. And then on the budget deficit, some thoughts given to funding tax and spending policies. Now, what they're looking at and what the market will be looking at is to assess whether what he says can ratify this repricing we had yesterday of moving to a 50% probability, i.e. priced in for a March interest rate hike. Or, after what he says, is it lacking detail to the point of which really there's not enough clarity at this point of time. There's no immediate stimulus kind of forthcoming, and so that lessens the need for the Fed to take more immediate action. So ING looking at the F's are key points to look at, which could in theory lift March Fed hike odds. One being on the tax policy side, gives tentative figures. Corporate tax may be cut to 20%. That's the number that's been floated in terms of the theory, but we've not really had it definitively issued by the president. The other thing on infrastructure spending would be infrastructure spending will be part of the 2017-18 budget. Therefore, he is clearly defining a timeline as for that to be implemented. And then for the budget deficit, credible revenue generating policies get outlined. So these are the 3 really key areas that you need to be looking for. Clarity over the corporate tax situation as to specific numbers, the budget for infrastructure, in particular reference to the timing, and then credible revenue generating policies are outlined. So this is all about adding meat to the bones, if you like, of the hints he's been laying forward, because historically this speech, which the president always gives to both chambers of Congress at the same time, it's quite a historical reference point for the administration to outline all of their summary of policies and timelines going forward. It's kind of like quite an authoritative stand by the president, usually, to outline everything he's going to do and when he's going to do it. As I said then, what could possibly go wrong? And this is where we lead on to this article from Mohammed El-Erian, who I think still works at Allianz, but used to be at PIMCO, which is the biggest bond fund in the world. Very highly respected guy, and a guy that some of you new guys should follow for his market opinion, because more often than not, he's exactly on point. And what he's talking about is markets risk rude awakening if Trump address underwhelms. And I couldn't agree with his sentiment more. If you look at the way that equities have been rallying so consistently, the best winning streak for 30 years, all of this is because markets price on future expectations. And that has been propped up by promises from Trump, yet we still haven't had the details as yet. That means then, from a market positioning point of view, Trump has a lot to live up to today, and that means for me the risk is to the downside. The downside being that this Trump trade, this Trumpflation, could get unwound, at least an initial knee-jerk reaction. That would be equities might come off short term, dollar would weaken, and US yields would start to move lower in reversal of the moves generally that we'd been seeing ever since November 8th of last year when he won the election itself. Again, the key areas that we're really looking out for here, well, if you look at the dollar, actually, just to quickly look at what I was just explaining, if you look back to the summer of last year, the dollar climbed on hawkish Jackson Hole speech from Janet Yellen. You can see here. Trump wins the election and promises to unite the US, sparking a dollar rally. Then you get the kind of Trump trade, Trumpflation. Robust US economic data, up to a 13-year high. We rally again. December of last year, the Fed raises rates. We rally again. And it's only until really we've come into this year that Trump's combative pre-inauguration press conference has started to make investors get a little bit uncertain as to how aggressive this 14 year high in the dollar was. But looking retrospectively from where we were, even towards the election, there's a long way down to pare back if Trump does not deliver. This Trump implementation risk is definitely a big thing to be aware of. If you look at equity markets, again, this is kind of just looking graphically then, looking at the speed and rise of the S&P, which has been pretty phenomenal, as has the other indices. You know, we were fretting over 20,000, I can remember just a few weeks ago in terms of the Dow, and here we are, in the futures at least, only around 200 points or less than that, shy of 21,000. So, as the markets, as Ariane says, in the business of pricing the future, these expectations have already been reflected in valuations. Stocks and corporate bonds have rushed to price hopes of stronger economic growth and corporate earnings, driven in large part by widening policy improvements after too many years of politically induced paralysis. Should such an expectations not be validated today, what follows in terms of legislative actions, markets could be in for quite a rude awakening. So in terms of positioning yourself, that's really the kind of baseline scenario that I think would be the most appropriate in terms of targeting this event for this evening. The risk here is that he underwhelms. Just so you are aware, let me just bring up Twitter, because there's something else you need to be aware of. Of course, Trump likes to obviously have a bit of a drum roll before his big appearance. So Trump will be interviewed by Fox at 6 a.m. So put that in your calendar, because as we said, the actual speech is not going to occur till about 2 a.m. London time tonight. But this could be him. He might want to fire out a couple of bullets early. You know, Trump, I'm sure, watches the financial markets, and he'll want to give, I would imagine, the strategy would be something positive, drip feed a little nugget of detail to then see equities rally again and the market perceive what he's going to say is going to be good. This could ultimately be to his detriment if then the speech doesn't live up to it. But I think, knowing how Trump has been communicating more recently, so this is going to be 11 o'clock our time, definitely be on the lookout for that. Okay, just quickly, a wrap up of some other things news-wise to have a quick look at. Greece has not gone away, but at least very much on the intraday and this week is a backseat to Trump and France still. But just so you're aware, Greece's auditors are pulling together a list of policies the country needs to implement to unlock additional bailout funds as they prepare for resumption of talks with Athens today, according to sources. So those talks are still ongoing. This, of course, the government expecting a bailout accord by March, early April. That does need to happen because the size of the debt redemptions in the summer, Greece will effectively go bankrupt. Now, a deal inevitably will get done, but this is just something to be aware of that is simmering in the background, and I think probably won't come back to rear its head really until early April, post some of the Trump details, post the Dutch elections, triggering of Article 50, so on and so forth. Talking of Article 50, this was something I was signing off with yesterday, and although we've had UK consumer confidence numbers from the GfK overnight, and they were for the month of February, the point I was making yesterday was that because it's February, I don't think it's going to have much of a market impact, of which, of course, it hasn't. But this is definitely the theme that I am very interested in going through Q2 and Q3 of this year, 2017, because this is where I feel that my thoughts about the confidence in Theresa May's government will ultimately come undone. What I'm saying with this is that this is the first sort of signs of what I've been looking for, and what I think will materialise going forward and will become more of a pressure point for politicians. And this is that British consumer morale has edged lower in February as rising inflation following last year's Brexit vote has made households warier about the outlook for their finances. And so two separate reports conducted by GfK and the pollster YouGov have pointed to increased financial pressures on households in the year ahead. Added signs that consumer spending, obviously the driving force behind Britain's economy over the last few years, is starting to wilt as the pressure mounts. Now for me, inflation is not even at target. It's going to go well above target. The Bank of England are telling us it's going to go at least another % above where it is at the moment. And that's not saying that they're even right, because their forecasts have a margin of error as well. Some think tanks are going at least 3.5–4%. What I'm saying then is that in the long run, this is going to put immense pressure on households in an environment of economic uncertainty with Brexit and negotiations surrounding that with Europe, in addition to rising inflation and the impact on households. I think that's going to be where Brexit becomes a reality for the UK public later on this year. But look, I don't want to be too doom and gloom. It's only Tuesday after all. Okay, quickly, looking at this morning then, we've already had a quick look at this. It's pretty quiet for this morning. Really, it's a US-oriented session. The one thing I would insert in here, as we've just said, Trump interview, Fox News, 11 o'clock London time. Definitely be on the lookout for that. Then you go into the 130s. Core PCE is an important number for the US. I'd give that a higher weighting than the trade balance number from the US or wholesale inventories. Then later, Chicago PMI, another important number, alongside Richmond Fed manufacturing and the consumer confidence numbers. So really 1:30 and 3 o'clock, you're getting your major data. Could well be fairly muted though reaction given the importance of Trump and the speech later on this evening. Okay guys, gonna leave it at that. I've seen a few questions into the chat, so I'll address those shortly. But enjoy your session, and I'll see you in the chat room.